Hello and welcome to ActivTrades News. In the era of abnormal rates, is nowhere now more bizarre than Europe. Of 13 countries flashing negative yields in international debt markets, 12 of these are European. And after years of central bank action designed to haul economies out of the maelstrom of the financial crisis, including about $12 trillion of asset buying, near zero interest rates in the US, and negative rates in Europe, investors seem convinced that further European stimulus is on its way. With the ECB is one of the four big central banks to have lowered policy rates into negative territory, along with Denmark, Sweden and Switzerland. Switzerland's 2-year borrowing costs have dropped as low as -1%, and even Italy, burdened with scant growth and one of the world's highest debt to GDP ratios, has managed to borrow at sub-zero rates. And if markets are right, this may be just the beginning. Greece is apparently planning a return to capital markets. With the country making preparations to rejoin global debt markets less than 6 months after a standoff with bailout lenders, the country is close to a forcible ejection from the Eurozone. Thankfully, the situation has eased following the government's deal with European creditors for a further €86 billion bailout in July, and Greece is now preparing for a market return that could come as early as the first half of next year. The world's leading energy forecaster, the International Energy Agency, has said that an oil glut is set to swamp demand until 2020. In its closely watched annual outlook, the IEA has said that the oil market will remain oversupplied until the end of the decade as an unstoppable push for cleaner fuels and greater efficiency offsets the effect of lower prices. Forecasting that demand would rise by less than 1% a year between now and 2020, a slower pace than necessary to quickly mop up an oil glut that has driven prices to multi-year lows. With the collapse in Brent crude from $115 a barrel in June 2014 to below $50, that has battered the budgets of producer countries and forced the world's biggest oil companies to slash investment. The slowdown in oil demand growth follows a near 15-year surge in consumption, driven by the rapid industrialization of China and other emerging market economies. Is the emerging markets slowdown the third and final wave of the global financial crisis? Phase 1 was the US wave that started with the housing market collapse, spread into a broader credit crunch, and ended with a Lehman collapse and the start of QE. Phase 2 began as banks in Europe faced severe losses, but quickly became a sovereign crisis, given the lack of a debt-sharing mechanism across the euro area, and ended with promises to do whatever it takes. And the introduction of Eurozone QE this year, and just as Europe appeared to emerge from its crisis, Phase 3 took shape in the form of collapsing commodity markets and weakening emerging markets. In an unusual paradox since 2010, falling consumer and commodity prices have sat alongside sharply rising asset prices. While this can be explained by both weak global growth relative to trend and the aggressive policy response of quantitative easing, which has helped boost valuations in asset markets. These phenomena are precipitating fresh concerns about the sustainability of asset price rises, which are arising principally out of uncertainty from the fallout from weaker emerging market economies, lower commodity prices, and potentially higher US interest rates. And now we're joined by Nicole Elliott, a financial analyst. Thanks for joining us, Nicole. Looking at Europe now, and has the ECB explicitly reopened the doors to further cuts?
I think they have, actually. The Eurozone economy is not doing well. We all know it. And Mr. Draghi said he's going to do whatever it takes. So now the question is, let's see what sort of rabbits he's going to take out of his hat for us. December is very likely. Why not? They've been dropping all sorts of heavy-handed hints, haven't they? And I think it's just a matter of time before we find out what's round the corner.
Do you think that the ECB may be willing to drive rates deeper as early as December?
Very definitely. So they're charging banks minus 20 basis points to hold their money at the central bank. But what's actually happened so far is that a lot of people have been shielded for this. They haven't been affected yet. Retail banks have not wanted to charge their customers to hold their money, so it's not being reflected. So the question then is, at what point will the commercial banks pass on these negative rates to their corporate and retail customers? A few corporates are actually being charged at the moment. And how much more will we do? Well, I think and interest rates is very much a global scene these days. Everybody's like, shall I pop my money here or shall I pop it over there? And we can see that 2-year German Schatz paper, government paper with a 2-year maturity, today is yielding minus 38 basis points. So, do you know what I mean? We've discounted that already. In other words, from minus 20, we're probably discounting something like minus 40 within the next couple of months or so. But the real question is, when will it start impacting the wider public?
Does the ECB have a bias to do more, and not just with quantitative easing, but also with rate cuts too?
I think so, and I think what they'd also love is if politicians help them along a bit. Do you know what I mean? All the lifting since 2012 has been done by the ECB, and governments have done really precious little. And as for the reorganisation of the banking system, that is moving along at a snail's pace. So I think the ECB is right to put pressure on fiscal changes to encourage investment and entrepreneurship. And likewise, I think they're right to push for a faster move to recapitalise and reorganise the financial system.
And moving over to Greece now. Now, if Greece is able to sell international bonds in 2016, how much of a turnaround will this be for the country's fortunes?
Let's just say one step at a time. The ongoing discussions appear to have been resolved this morning. Finance Minister Sakalotos came out saying that the Troika and the deputy finance ministers of the Eurozone countries have come to an agreement which will free up €2 billion worth of aid and €10 billion of recapitalisation. A lot of the discussions had got stuck on not being so harsh on foreclosures for the very poorest of those with mortgages, but they seem to have resolved that this morning early, so hopefully that'll move along. Now, this is just the first step towards eventually coming back to the capital markets and issuing new debt, because let's not forget, the biggest buyers of sovereign debt are usually your local banks, so they need a solid banking system to then have the appetite to buy some of the hopefully new Greek bonds that they will issue eventually at some point. When I say eventually, it also matters at what interest rate you're going to issue paper, because there's always a price for everything and anybody, but if you start issuing at really, distress levels, bankrupt type levels, it makes you look bad. So you really only want to issue new debt if you're fairly comfortable that you do have enough buyers, and you can sort of do a book building exercise before you even consider something like that.
Looking at the oil story now, and with the oil prices stuck at $50, how long do you think before we can see an impact on future oil supplies?
I think we might find that crude oil, NYMEX crude oil, is stuck at about the $50 a barrel for a very long time. I've had a serious look at my charts, and that's where I make my big decisions, are always based on technical analysis. And realistically, I could see front month futures contracts trading between about $35 and $55, $60 for maybe up to 4 years, actually, really long time. In some ways this is a good thing, in that it'll get us all sort of get our heads round to a far more stable energy regime, which has not been the case since about 2005, when the whole commodities boom sort of took off, and energy was one of the big focuses of a lot of financial speculation, may I add. I think all the moves above $105 are the abnormal, that is the aberration, and normal is somewhere closer, as I say, to the $50-$60 mark, which we could be for a long time. This in turn will lead to a lot of reappraisal of energy sources, consumption and all the rest of it. And I think the main thing in the long term is that young people definitely are far more conscious of the impact that carbon fossil fuels have on the environment, and how really we ought to consider in every possible way reducing our consumption. And I think that philosophy and that psychology is here to stay and will increase over time, and so therefore the demand for energy is likely to decline.
Looking at the emerging market slowdown, now what are your hopes that the emerging market slowdown will pass by without dragging the global economy into another downturn?
Well, I hope so, really, because it matters to so very many people, and often, you know, the people who are least able to afford a downturn. So, you know, it's all, I really would hope so. But the reality is that emerging markets, in a way, are a decade behind what happened to developed markets, but what they're both going through exactly the same thing, which is a tremendous boom in not just cheap credit but easy credit, which was then misallocated a lot of the time into, you know, the stock market and this, that and the other, residential housing, whatever, consumer spending, the lot. We've all done it, we've maxed out on our credit, and suddenly when things don't go so well, we've got to tighten our belts. And it's a process of deleveraging, and low interest rates and a rather sort of boring, pedestrian, steady as she goes type economic environment is about the best that you can hope for, so that you don't crash and burn, but that you're given plenty of time to reorganise your debts.
Thanks for joining us, Nicole. And in this week's weekly forecast, on Thursday the 19th, we'll see Fed Chair Janet Yellen, who is due to deliver opening remarks at the Conference on Monetary Policy Implementation in the Post-Crisis Period in Washington, D.C. And on Friday the 20th, we'll see German preliminary gross domestic product, the broadcast which measures the economic activity and the primary gauge of the economy's health. The preliminary release is the earliest and thus tends to have the biggest impact. And that's it for this weekly news. Please join us again, same time, same place next week.